Hello, welcome to the African Trade Show on Business Front TV, where we bring to you the business of a borderless Africa, the money, the markets, and the movements powering Africa's trade. Every week, we'll explore what it truly means to move goods, services, people, and capital seamlessly across the continent. On today's Trade Tracker, we spotlight African countries and US new tariffs. African countries hit with new US tariffs. Nigeria puts the lead on raw material exports. Nigeria readies special agro-industrial processing zone. The United States has imposed new tariffs on imports from several African countries. Following the expiration of a 90-day negotiation window for trade deals, the US President Donald Trump signed an executive order on Thursday, July 31st, introducing tariff rates ranging from 10% to 41%. South Africa has been particularly hit, facing a 30% tariff on its exports to the US, despite intensive last-minute negotiations and proposals. Nigeria also sees a smaller hike, with its tariff rate increasing from 14% to 15%. Meanwhile, Lesotho received a partial reprieve. Its previously threatened 50% tariff has been reduced to 15%, offering some relief. Other African countries, including Angola, Botswana, Ghana, Mozambique, Namibia, and Zambia, are primarily facing a 15% tariff. While nations like Algeria and Libya see a 30% tariff, Tunisia faces 25%. These new tariffs come at a challenging time for many African economies, grappling with food security concerns, inflation, and the lingering impacts of global economic shifts. Next, we spotlight Nigeria's new bill that could shake up how raw materials leave the country. Nigeria's Senate has passed a bill mandating that all raw materials must be at least 30% processed locally before they can be exported. Non-compliant exports will face a 15% levy on the export value of the raw materials, risk losing their value addition certification, may face suspension, or have these goods tagged as smuggled. The Raw Materials Research and Development Council, RMRDC, will be responsible for setting the guidelines and benchmarks for the enforcement of the new bill, and the level of processing will be assessed based on the nature of the product, the technology used, and the standards required by the trade capital market. But what is the feasibility of this policy? The new raw material processing mandate could strengthen the country's export value and may shift its raw export economy to a processing-led trade growth. However, on the other hand, modern processing technology, transport and logistics, and even power supply are some of the challenges still plaguing the rural areas where these local export products and raw materials are sourced. Many small and medium exporters cannot afford modern processing equipment. Some rely on manual or semi-mechanized methods that may not meet the 30% processing threshold. These exporters may be hit with processing costs, as this adds an extra layer of machinery, labor, energy, logistics, which those in sectors like agriculture and mining may not absorb without losing competitiveness. They may struggle to understand or meet the benchmarks and may even seek to avoid the policy by rerouting goods through informal or illegal channels. While the RMRDC drafts out a framework that defines what counts as a 30% processing, local exporters wait to see how this pans out, especially for different sectors. Next, we turn our lens to Nigeria, who has launched the first phase of its Special Agro-Industrial Processing Zones program with a $538 million investment. This first phase spans 7 states and the Federal Capital Territory, accounting for nearly 1/5 of Nigerians' landmass. The initiative is expected to draw $1 billion in investments by 2027 and cut post-harvest losses by up to 80%. Backed by the African Development Bank, the Islamic Development Bank, the International Fund for Agricultural Development, and other development partners, the SAPZ project will focus on high-value crops and livestock products, aiming to boost domestic productivity, improve life in rural areas, and enhance agriculture-related industries. Beyond food security, SAPZ ties into bigger trade ambitions, like Nigeria's AFTA commitments, intra-African food exports, and rural industrialization. Let's turn to some interesting deals happening in Africa's trade scene. Ethiopia is set to become Africa's biggest trade market. In July 2025, Ethiopia deepened bilateral trade ties with two global partners. It signed a memorandum of understanding with Italy to boost agricultural productivity, especially in coffee value chains, one of its biggest export economies. And then a new partnership with the UAE to expand cooperation in agriculture, trade, and investment. This comes at a time when the country has just begun implementing its AfCFTA free trade commitments, connecting to a market of 1.3 billion people with a combined GDP of $3.4 trillion, a big play for its export base and industrial growth. Not forgetting that the country also secured $1 billion in funding from the World Bank, which includes a $650 million grant and a $350 million concessional loan. So what does this mean for Ethiopia? With over 120 million people, Ethiopia is Africa's second most populous nation and a key player in the continent's trade sector. This could improve its position in Africa and even the global market. Remember that the country is still emerging from a period of internal conflict, inflation, a debt default in late 2023, and fiscal strain. Well, trade offers a pathway to grow its economy, earn foreign exchange, and stimulate different sectors. At the Africa Caribbean Trade and Investment Forum, held on July 30, 2025 in Grenada, over $290 million in trade and development deals were signed. A major highlight was the proposal to establish a Global Africa Commission, a permanent body led by the African Export-Import Bank, Afreximbank, the African Union, and the Caribbean Communities, CARICOM, to drive long-term integration between Africa and its Caribbean diaspora economies. The event also saw the groundbreaking of the African Trade Center in Barbados, marking the continent's first major physical trade hub in the Caribbean, and the launch of the Caribbean Payments and Settlement System, CAPS, modeled after Africa's Pan-African Payments and Settlement System, PAPS, and a $250 million Resilience Fund to finance climate and development projects. While there have been previous initiatives in the past, such as the Afro-Caribbean Summits in 2021 and 2022, this is the first time concrete financial and physical trade structures have been rolled out. There have also been a history of trade deals between Africa and the Caribbean. However, the shares of bilateral exports between both have never been more than 6%. And according to a study by Afreximbank, these shares could grow up to $2 billion within the next 5 years. This deal could unlock potential growth for both markets, especially since most of the Caribbean now face a blanket 10% tariff on export goods to their biggest trading partners, the US, which gets 40% of its total exports. Presidents William Ruto of Kenya and Yoweri Museveni of Uganda signed 8 new MOUs during Museveni's official visit to Nairobi. The agreement builds on 17 existing pacts, bridging trade barriers and fostering socio-economic integration. The projects will include extending Kenya's standard gauge railway from Naivasha to Malaba into Uganda and dwelling the Nairobi-Nakuru-Mau Summit Road through to the border to reduce transport costs and improve regional trade corridors. Kenya's and Uganda's Bureau of Standards will harmonize quality control and certification processes, easing the flow of goods and reducing counterfeit products. This pact seeks to jointly market East Africa while strengthening community and cultural linkages. However, this comes amidst Tanzania's business licensing order, which bars non-citizens from engaging in diverse activities, including retail trade and mobile money services. While existing license holders may continue operating until their permits expire, new licensing applications will be denied. Violators face up to 10 million Tanzanian shillings in fines, 6 months imprisonment, and loss of visa or work permits. Meanwhile, Kenyan authorities have branded this directive as a clear violation of the East African Community Common Market Protocol, which prevents discriminatory treatment and ensures free establishment rights among partner state nationals. Kenya's MITI has called for the order's immediate withdrawal, citing Article 13 of the EAC Protocol. The country has requested bilateral consultations, calling for EAC-level engagements, including a joint trade committee session in Arusha in August to address the issue. Today, we're diving deep into a vital but often overlooked layer of Africa's trade ecosystem, and that is payments. Moving money across African borders, whether to settle trade deals, fund logistics, or enable services, remains more complex than it should be. Joining us is someone who has worked at the intersection of commodity trading and financial infrastructure. Nathaniel Agama, CEO of Brydge.
For an importer, we'll take it step by step in terms of the different point of views for each business. So for a business that's importing within the African ecosystem, they're worried about payments. How do I, pay my suppliers efficiently, timely, and reliably in a way that is also consistent. For that importer as well, they're also worried about finding the right vendors or suppliers that they can get the best quotes and rates from, especially if you're trading within Africa again. And then the business that is importing is also worried about the logistics of it. How does it get to me? How would it come to where I am? And then in between all of that is the tracking. Where is it at? What have we done? What haven't we done? And that bit. But it looks a little bit different for a business that is exporting out of Nigeria to maybe other African countries. For that business, you are worried about where do I find reliable buyers, reliable off-takers, excuse me, and then that exporter is also worried about how do I collect payments. Largely, within trade in Africa is still very USD based.
Yeah.
And the reason is not far-fetched. The reason is just because as a business here in Nigeria, first off, I can't collect Ghana cedis from you. It's a lot easier to say you go convert your Ghana cedis to US dollars and then use that to pay me, because then at least there are domiciliary accounts that I can use to receive that. And also aside from that, there's also a macroeconomics that comes to it, where you are worried about the FX changes of if I'm holding Ghana cedis and then tomorrow it falls off, what's the problem with that, or Kenyan shillings, or whatever the case may be, or Nigerian naira. So we've seen how it goes up and down. So it's a lot easier to just trade with dollars, because US dollar is US dollar anywhere. So yeah. So those are so you all kind of so why I took out the time to just explain the point of views from two different lenses is that both of these persons I just explained, or businesses, are Nigerian businesses, but they have a different problem across, depending on what they are trying to do, whether they're exporting or trying to import.
And it's the same for other African countries?
Yes. If you look at it from other lens, same thing, a Ghanaian business trying to maybe sell into Nigeria, they're worried. I don't have an NIN to get a bank account here in Nigeria, so how do I do that? How do I trade with them? And if I'm going to sell in USD, would the Nigerian business be comfortable going to go source USD just to make payments? So,
Okay, so speaking of payments, I think that somehow moving money is much more complex than actually moving goods across borders or within Africa. So how does payments interoperability slow down the deals between African countries?
So I think that I beg to differ that but payment is easier. I think both are difficult. If you really think of it in the granular scale of it all, yeah, all just depends on the lens you're looking at it from. But we're talking about intra-Africa trade first off, and we're talking about 42 different currencies across 52 countries, across over 42 different means of payment. But at least you can say maybe the core ones are 7 or 8. But I always like to, at every point in time I speak about intra-Africa trade, I like to think of it like you're educated, just so that people can understand and really value what the problems are. So for instance, if you're in Ghana and you have mobile money. When people talk about mobile money, it also feels like mobile money is mobile money everywhere, but it's not. Mobile money in Ghana is not the same for mobile money in Kenya, right? They are mobile monies, but they're not the same thing. And I still can't move mobile money from Ghana to Kenya, even though it's mobile money, right? So it's not the same. And even within, like, say, for instance, if you now go to Francophone regions, like in Kenya, in Cameroon, Ivory Coast, and the likes, moving money across those parts is a lot easier, is a bit easier, but the networks that they have are independent. Say network A can't move money to network B, even though network A and network B are both mobile money networks, right? I don't know if I'm allowed to mention names, but I think those are the kind of things that you see. So yes, interoperability like slows down payment because systems that are supposed to be speaking to each other are not, and then it just kind of makes it difficult for you to really just do the things that you're supposed to do without worrying about, oh, what mobile money do you have, or what other mobile money does this other guy have. Same things with bank transfers. Just because you have Bank A in Nigeria that is also present in the other country doesn't essentially mean that because that person has that bank account in that same country that you can move money from here to them. It's not the same thing, because all of them are also like working in their own silos, even though they bear the same name in those countries. So it's not that. So yeah, just wanted to really, because sometimes we just really say things like the plurality and stuff like that. Most persons that we might be watching some of these things are not bankers. You understand what that really looks like, but when you paint this picture that, case in point, while we're going far in Nigeria, a DOM account within a bank, a USD account that is not within that same bank, you can't move US dollars from bank A to bank B. Yeah, so that just explains.
Okay. So speaking of payment systems between countries, so the AFCFTA recently introduced the PAPS card. So how does that work exactly? Is it like, oh, I have my debit card here, or I'm a Nigerian going to maybe Ghana, and I have that debit card. Will I be able to use it with my Nigerian naira in another country? Is that how it works? Or what's
Yes. Like I earlier said that money is not moving, right? So that your Nigerian naira is supposed to still be of value anywhere, because it's just a thing of what's the conversion of naira to Ghana cedis. So it's for the central banks. That's now where the PAPS thing now coming, like the Pan-African Settlement System, where the Ghanaian Central Bank and the Nigerian Central Bank are the ones holding the ledgers of this is how much Ghana is owing Nigeria, this is how much Nigeria is owing, and then they're balancing each other's out, reconciliation and all of that, right? So the card is just to say, you have your Nigerian PAPS card with your naira in it, you go into Ghana, you just tap, it's the switch, which is PAPS, will then convert your naira, debit your position, and then credit the local merchant in Ghana cedis.
So you necessarily don't have to move like money or then convert first.
Yeah,
and all of
it takes off that whole need for cash. Yes.
Okay, but then for that to be possible, there has to be like the AF after.
Yes,
so it's meant to not just, when we talk about trade, trade is not just importing and exporting. It involves movement of goods, services, people, and all that. So I have to be able to be in that country for me to be able to use my PAPS card.
Yes.
And that brings us to the problem of visas, being able to travel within Africa itself. So that's a problem on its own. So what do you think it's actually the main, will I say the main cause or the main trigger for that? Like
For
issues,
visas,
yes, issues between traveling between countries. But what's the main thing there?
The questions can sometimes put me in a political problem.
Yeah.
But I would speak from what I know, right? Where there are 8 protocols from the AFTA region, and one of that is, access to free tariffs for goods or free or low tariffs for products that are moving within the continent.
Oh,
And what that just means is that, okay, if I'm importing something from Ghana, I shouldn't pay the same custom duty or tariff as someone who is importing someone from China and all of these other countries, right? Just to also improve, the need to get those type of products from within the continent. Like I already highlighted, where Kenya used to do a visa on arrival or electronic visas for Nigerians, and now they've moved to at least 60 days free, I think, free visas. So my assumption, I would like to put it that way for people who would pick it up, is that this conversation, this whole after thing, after agreement, it would lead more countries to then have a lot more interpersonal relationship, especially if you know that I'm trading a lot, like Nigerians are trading a lot with Kenya, Nigerians trading a lot with South Africa, right? Yeah. If I'm trading a lot with you, then there has to then be that more or less, like how best to put it would be, lowering of requirements to come into the country if I'm already trading with you. So those conversations would kind of like come off the bat that trade is already happening and after is in place, right? So that's my assumption, that we'll see a lot more countries lower their expectations as far as like other African countries, so that they can also promote the products that they have, and they can also allow more persons coming to see the country, experience their products, and then buy from them. And this is also very great when you see things like Rwanda allowing a lot of countries go to them. You see there's a lot of trade happening with those regions and things in that regard. So off the back of the AFTA project, more countries, more unions, more trade blocks. There's an ECOWAS trade block, there's a SEWA trade block. So those trade blocks will start speaking to themselves, and then within the AFTA agreement, and then start finding ways to allow each other move money or move people, move, maybe instead of it to be like free for tourism, but if you're doing business in these countries, it's a free visa, you don't need to, so things like that.
So you mentioned the ECOWAS bloc and all of that. So I think, was it last year when Burkina Faso, Mali, and Nigeria, they had to leave the ECOWAS. So for trade within those blocks, now that means they are now excluded from those trade,
the trade
advantages?
Treaties, yes.
So how then does trade between those countries now, how does it now become?
Okay, no, so like let's go back a bit, right? The North American Free Trade Agreement, the NAFTA, covers all of North America, but there are still trade blocks within North America, right? That happens in their own small niches. Yes, North America.
Oh, okay.
Right. So I'm coming back to Nigeria. So I wanted to use that to establish what I want to do now, because it always feels like when we speak about Africa Free Trade Agreement, it feels like it's new. But these things have, always existed. We're just starting ours today, right? So the Africa Free Trade Agreement is an agreement that covers all of Africa. So those blocks exist under this new agreement.
Okay.
Right? They exist under this new agreement. So the AFTA thing covers all 54 countries that have signed the treaty to do the free tariffs and do the whole 7 stuff. So whether you left the small or the block of ECOWAS, as long as you've signed that treaty, you're part of the Africa Free Trade Continental Agreement. You're no longer part of the blocks, but you're now part of this thing. And what my assumptions would also say is that this Africa Free Trade should supersede whatever blocks has been created, because the whole idea was to have a North Africa block, a Southern Africa block, a Western Africa block, and all of that, East African blocks and stuff. But that, created these fragmentations that we are seeing. So if we're all one continent, all one people, then let's have, just that one block that speaks to ensuring that, the smaller guys are benefiting from the resources of the bigger guys are benefiting from the labor of the smaller guys. So that way we all are moving and enriching each other.
Oh, okay. So I think recently, I think we just recently said too, I think between South Africa and Tanzania, there were these clashes, trade clashes between them. So one country was like, oh, we're not going to accept this from this country. And then the other one was like, oh, we're not trading this from this country because you stopped trading with us.
Yeah.
So in that case, what this AFC,
TLT.
what now happens? How do they come in, or how does that settle things like?
Yes. So I think it would always happen, right? Just because there's a trade agreement doesn't essentially mean that we all would be all kumbaya or like, hello, everything is good, right? Bear in mind that this Africa Free Trade Continental Agreement started 5 years ago, like the official agreement started 5 years ago. It took 1 year for all countries to then go back, rewrite their constitutional files like border controls and everything. And then it took another 1 year for all of them to review and agree, and another 1 year for them to sign their treaties. And then just, if my memory serves me right, like 4 months ago, that the first shipment from Nigeria left under the AFTA agreement. Oh. So, so it's not going to just happen overnight. Like, it's not just going to be like, oh, just because there's an agreement, all of a sudden, I want to open up my borders, everybody should just come in and do whatever they like. So there's just going to be that phasing of, okay, these things fall within the Africa Trade Agreement, this doesn't, or these are gray areas that need to be ironed out. There will always definitely be trade wars. We already see one that America and China had. Those countries had a trade agreement before, so that's pretty much like what we are doing, where there's a trade agreement, there's a handshake that we should do this, tariff should be here, but you should expect that where there are interests, conflicts should happen. So yeah, so in terms of that, in regards to that, those cases would then go to the Africa Free Trade, maybe Parliament or something, to iron them out and smoothen them out, because they are also, like I mentioned, like there are protocols for how would information be stored. There are protocols to how women and youth should participate in that conversation. There's also a protocol for how this, that, and that. So all those protocols speak to this. So I'm making an assumption that there should be a protocol that speaks to conflicts and resolutions between different countries. So yeah, it's not.
Yeah. So, but then it affects the traders in that country that are maybe not directly under the AFTA. Then they are trading. So having those kind of, or maybe at that point there's now like border restrictions between each country. So how then, or how do these traders now have to deal with those kind of things?
Again, I like that there's already a precedent around that, where China, Nigeria, China, America, right? They were having problems. It was their president too. Their presidents were the ones giving tariffs up and down, but the guys who were actively trading were not able to move things, because then when the big guys fight, the small guys have to adjust. It is what it is. So yeah. Then the other thing that could just happen would be you trading within outside the confines of that agreement, where again you put me in tight spots, but where, like, let's say for instance, if Nigeria is banned from supplying XYZ to, say, another country, right? Some farmers can move those goods through Niger and then supply from Niger to that country. Yes.
The stories of regional collaboration, the power of intra-African trade, and the policy breakthroughs driving Africa's shared prosperity. This is Inspired Africa, the pulse of continental unity and innovation, where we spotlight moves, deals, and collaborative dreams turning into reality across African borders. In this segment, we uncover how Nigeria's capital market can fund warehouses, ports, and processors. With us is Mayowa Ikotun, head of Coronation Infrastructure Fund at Coronation Group. So let's get right into it. Talking about how the Nigerian capital market can actually finance ports, warehouses, and processing facilities. So how would you describe the logistics, the Nigerian logistics and processing infrastructure?
Okay, so that's an interesting sector, and it's a sector that, if properly harnessed, can really drive the economy of the country. This is because there's so many sectors dependent on what happens around infrastructures of warehouses, ports, and logistics. We talk of sectors like agriculture, where farmers need to store post-harvest goods. Talk about retail, e-commerce, oil and gas, pharmaceutical. It cuts across so many sectors. So this is a very important sector. But unfortunately, currently we don't have enough of these facilities to cater for the current need. Let's take it one by one. Warehouses, for example, we don't have enough storage facilities across the country to ensure we are self-sufficient and have enough to export, and with the goods still remaining in good conditions. When you talk about ports, most of the trades that happen in our ports happen with Tinkan and Apapa port. I think almost 70% of it. So what happens to those in far regions that need to either import or export goods? So we need to look at enhancing and making other ports across the country fully functional, and also reduce the pressure on the Lagos ports. And for logistics, I think it's getting better, but quite a lot still needs to be done. This is huge. It's hampered currently with insecurity and not a lot of players still operating within that space. And probably few regulations, either states or regulatory regulation, still hindering what happens within that space. But it's still a huge, it's a sector with huge opportunities to operate in.
Okay, so in terms of funding, why is it so difficult for traditional financing like bank loans or public budgets to actually meet the capital needs of these infrastructures?
Okay, so I would say the banks are trying, but like I said earlier, there's a lot to be done in that sector. Then for those that are currently not able to access finance, or not accessing enough, few factors. One, there is a financing tenor mismatch. So what do I mean? I want to probably build or construct a warehouse. I would need time, right? You need patient capital, something that gives you time to construct, operate, then start making this repayment. But with the typical bank structure, it's probably short term, 18, 24 months. You are required to pay back both the interest and capital. So this puts pressure on these business owners. So they look forward to long-term financing that gives them ability to fully settle in without pressure on repayment, and also the facility well spread across long term of, say, 5 to 10 years. Then also some of these business owners, the structure and the corporate structure of their operation sometimes hinder them from accessing its financing. Some no credit history, so many things not well put together. So it takes time for them to get to this position. Lastly, I would say what also hinders them is on the security structure. So they're not able to provide either guarantees, or they don't have collaterals to use to back these facilities from the bank. So all these affect them accessing finance from the bank, and also even the bank playing heavily as they might have wanted to.
Okay, so given these limitations now, where does the capital market come in?
Okay, so Capital market comes in various points. I'll start from my sector, infrastructure fund sector. So the fund was set up having noted the infrastructure deficits within the country. So it gives these business owners ability to access long-term funding with diverse structures different from how a typical commercial bank would structure its credit. And it also helps when it comes to the interest rates. It's a little bit moderate compared to what a typical commercial bank would give to them. So they're able to access this finance, and also they're able to access funds from other investors who had invested in the fund. So one, it gives them ability to plan their expansion for a much longer period with little pressure on repayment, and also help them when it comes to the interest on repayment.
Okay. Okay, so why should these infrastructure developers now turn to the capital market?
So even aside from accessing from the infrastructure fund, there are other instruments, commercial papers, for example. We've seen quite a lot of players within the sector come to the capital market. So players within the capital, such as investment bankers, have had to work with them, structure the business properly, and bring them to the capital market to raise funds. So while working on long-term plans, they are able to access finance through commercial papers to sort short-term and working capital needs. Also, along the line, they are even able to do much more by accessing long-term fund via even raising a bond with well-structured guarantees and other well-structured package to help their businesses. Then we've seen some of them even come to the capital market to raise equity, which is a long-term play, and making various other investors participate in their business. So the capital market has opened these many opportunities, which many players are currently accessing and enjoying the benefits.
Okay, so what capital market tools do you think are best suited for these infrastructure projects?
Okay, so first it depends on the strategy and plan of the business owner, what they're trying to achieve. Like I said earlier, say you are in the process to accessing the long-term financing, probably from international partners or even banks, maybe a bank of industry, for example, which the process will typically take a long time. So you can come to the capital markets and structure a commercial paper to work on your short-term financing. And also, like I said earlier, bonds can also be structured, right, to ensure they solve their long-term play. We've also seen quite a lot of players come to structure private placement that helps fulfill their various obligations. And like I said earlier, we've also seen some come to raise equity aside from debt instruments in the capital market, either private equity or raising via platforms such as NGX.
Okay, so let's move on. What are industrial REITs and how can they back with financing?
Okay, so let me try to break this down. We see quite a lot of people play around REITs now, but some probably not in a well-structured way. They are structured REITs approved by Securities and Exchange Commission that some houses are currently operating. But we want to bring this down to the context of what we are saying. So what we're trying to say is, say, as against everybody building warehouses. So we have one warehouse in Ikeja where people can come pay some certain amounts for a period of time and make use of this. Then there will be investors behind that have probably put funds together to ensure this is a reality, then you can make it unitized where everybody then gets a bit of the pie depending on how their contribution to the capital is. So it's something that could also work, considering the situation where I think it would also work very well with players around retail and e-commerce sector, where you don't need a warehouse for a very long period of time. You don't need it for short term whenever you have your goods. So you could have silos of these across the country. Then you well put down structure can then be structured behind to have investors, to have trust, to have full structure on how people can then participate and make good returns.
Okay, so let's talk about the NGX. Can you walk us through how a port operator might use a bond insurance on NGX to finance an expansion project?
Okay, so let me take this through two ways. NGX has been a very good platform for quite a lot of investors. So any investor going to the NGX platform is looking to invest in an entity that has listed with NGX and either for capital appreciation or to be part of what the company is doing. So the NGX has also allowed infrastructure funds to list on the platform where retail investors also participate. So if an infrastructure fund lists on the NGX platform and an investor participates, so what in turn has happened is you've participated in the fund financing business owners that are seeking funds to construct projects across warehousing, logistics, and ports, right? So the second part would be the business itself coming to list on the exchange, and that will take some process from corporate governance and it will take you having financial advisors to work with you all through the process and putting your books in order to list on the exchange. So once you list on the exchange, that means you've opened the company up, right? Make it a public entity. Then you have more financing to continue to expand your business and plug whatever infrastructure gap you have in the business.
Okay, so Nigerian's pension fund has a large AUM.
Yeah.
So what would you say is the potential for pension funds and insurance assets to be used in funding infrastructure?
So PFAs have played a very significant role in investing in infrastructure funds. I think as I last checked, the total investment in infrastructure fund by PFAs is roughly around 900 billion in infrastructure fund and other alternative assets, right? So they've played significant role to drive this sector of the economy, and they continue to. So they're a very significant player in that sector, and their continued participation had also helped in at fulfilling the fund's various objectives to reducing the infrastructure deficits within the country. So there are guidelines across PENCOM and NICOM for both PFAs and insurance companies that allow them invest in these funds, and they continue to participate actively.
Okay, so what are some of these guidelines that they have to follow?
I think for PFAs, they are allowed to invest at least like 5% into infrastructure and specialized funds. NICOM also gave specific guidelines as regards how insurance companies can invest in such instruments, which includes the credit rating, promoters, key management staff, and all that. So there are clear regulatory guidelines to both PFAs and insurance companies on how they can participate. So that takes away the bottleneck of, we don't know if this is something we can do, but so it's been clearly stated in both guidelines. So, and they've participated well so far within the infrastructure fund and other alternative assets.
Okay. So speaking about regulatory guidelines, what are some policies that are still restricting the capital market from investing in these warehouses, ports, and then infrastructure projects?
Okay, so as much I would say all regulatory bodies have been very supportive, from the Securities and Exchange Commission to PENCOM and NICOM that we just spoke about, by at least giving guidelines on how to register these funds, how to structure these funds, how to finance various projects, to the reviews, and how PFAs and insurance companies can invest, right? So, so it takes the first bottleneck off. Can there be enhancements to make things better? Probably yes. But we've seen the regulatory bodies also have showed willingness and listening ears to concerns and feedback on how to get things better. So I would say so far it's good. We can, and they've been very good cooperation between the operators, the capital market operators, and the regulators to continue to improve and get things better. And as you know, there was a recent ISA 2025, which is part of the regulator taking feedback from the capital market and taking quite a lot of ambiguities off whatever rules and regulations are across various parts of regulation. So it's been good so far. We can only just continue to work together to make the regulations better.
So there are no policies that are actually still standing as barriers or like restricting the capital market?
No, so as like I said, so many people are now playing in that sector. We have many players come, both from investors to capital market operators to even project owners themselves. There's now much more awareness to what we are doing within the capital market. So, but like I said, it can always get better. We continue to work with the regulators to make sure things are better. But currently, there is no stiff bottleneck that is holding anybody back from doing anything.
There you have it. The capital market can actually aid funding for infrastructure development, warehouses, ports, and processes. Want to find out more about trade in Africa? Join us next week on the African Trade Show. I remain your host, Sunny Delight.